Good evening, Wabash. I'm very pleased to welcome you today to the Rogge Lecture for 2016. Thank you very much for everybody who came out. We are very pleased to have a chance to greet among us descendants of Professor Rogge. His daughter is here, and thank you very much for joining us. We are also pleased to welcome our friends from DePaul. I cannot see you in audience, but you are welcome. Our celebration of Professor Rogge's life requires few words for people that never met him. I'm one of those. I never met him, but he was a professor that taught at Wabash for many, many years and shaped generations of your predecessors to become responsible and decent men. Our topic for today is monetary policy. So along with being very pleased with relatives of Professor Rogge, we are super pleased to be able to welcome Mrs. Esther George, President of the Kansas Regional Fed, among us today. She has been at Kansas Fed for 34 years, 5 years as a president, and this year she's a voting member of the FOMC. FOMC is the committee that shapes our monetary policy. When you call your mom or grandma tonight, you tell her, "Grandma, I know who's shaping your interest rates. Now I know why you're paying such a high mortgage, or low one." Again, please help me welcome Mrs. George among us today.
Thank you very much. If you do call your grandmother, you tell her I'm doing all I can to get that interest rate up a little bit. So let me just begin this evening by saying what an honor it is for me to be here. It's an honor because I understand that the purpose of this lecture is to honor someone that was very important to this school, someone who made very important contributions to the field of economics. And it was a particular honor, Anne, to get to sit by you this evening at dinner, Professor Rogge's daughter, to talk about what his legacy was to this school, and frankly, it sounds like well beyond the grounds of this school. And so it is an honor for me to be here. It's a great honor for me to have learned a bit about Wabash College this afternoon. I took a tour around the campus with Dr. Hess and got to get a sense of the school and its very rich and long tradition in training young men for whatever field they go into. And so it's an honor to be here and to talk to you this evening. This is my first time, I believe, to speak in a chapel. And so I'm going to be as circumspect as I can in my comments, and also recognizing you are sitting on some very hard pews. I'll tell you what it is I'd like to talk about this evening, which is the tradition of central banking in the United States and the role of the Federal Reserve in the nation's economy. I'm going to, as part of my talk this evening, invite you into the room where my colleagues and I sit to make decisions about interest rate policy in the United States and how we arrive at decisions on those monetary policy settings for the country. And since I noted that most of you have foregone this evening's presidential debates, I'll also talk a little bit about some of the political fights around the central bank, both at its foundation as well as today. And so let me just say at the start, some of you may know well what central banks are, some may not. But central banks are really unique institutions. Their governments form them and assign them responsibilities for the circulation of money in an economy in order to make sure that there is enough, that there is not too much relative to how an economy can grow over the long run. And by virtue of those responsibilities, I would argue that central banks are sort of mysterious institutions to most people. That's because when things are going well, we don't have to worry about how they do what they do. But when things don't go so well, as in 2008 and 9 in this country, the public sits up and they pay a bit more attention to what caused this, who caused this, and whose job it is to fix it. So before I invite you into that room where the FOMC meets to make decisions about monetary policy, I want to take you back a little bit to understand how this institution is grounded in something that I think is uniquely American. And I'm going to take you back to the late 1700s, long before the time that Alexander Hamilton debuted as a Broadway musical. He held a more mundane place in our history. He was the first Treasury Secretary of this country, and it was Hamilton who had this idea that we should have a central bank in the United States. Not everyone agreed with him. In fact, this was a pretty hotly debated issue in this country, that it needed a central bank, because in the United States there were concerns at that time, having just broken away from England, that there would be a concentration of power in such an institution, or that special interest would control it to the detriment of the country. And so the question was whether a central bank here would be the handmaiden of government or of money men, or whether it would serve the needs of farmers, for example, who needed access to credit, particularly during certain times of their crop production cycles. As it turned out, despite this hotly debated issue, Hamilton prevailed, and in 1791, the first Bank of the United States was founded. It was given a 20-year charter, and 80% of the stock of this bank was owned by private investors, and 20% was owned by the government. And I might argue that this bank actually operated fairly successfully during its early years, although it clearly failed to garner the trust of the public. For example, among that 80% private ownership, once people learned that some British people owned stock in the U.S. central bank, there was an outcry. And bankers also resented this institution because they used to get the government's deposits. Now all those deposits went to the central bank and not with them. And so at the end of that 20-year charter in 1811, the charter was not renewed and the first central bank of the United States closed. And of course then following 1811, we had the War of 1812, and the very thing that Alexander Hamilton feared actually happened. The government began to print money to finance this war. And so Congress again turned to the idea, maybe we need to try again to have a central bank in the United States. They wanted it to be apolitical, meaning it would not try to serve the interest of government, but there was still a very strong populist sentiment in the country. And again, this issue of forming another central bank was hotly debated. This time, Congress said we'll do it a little bit different. We'll still have the private sector own 80% of this bank, 20% owned by government, but we'll let the government pick some of the directors. So out of 25 directors, the government got to select 5 of them. But by the time the second Bank of the United States had its 20-year charter expire, Congress actually was leaning toward renewing it. They found the operations to be relatively successful, but this time there was a president, Andrew Jackson, who made it clear he not only hated central banks, he wasn't a big fan of banks in general, and that if Congress renewed this charter, he would veto it. And indeed he did, and so ended central banking in the United States for nearly 80 years. So over those 8 decades, there was no central bank in the United States. The economy grew, the number of banks in this country proliferated in providing money services to farmers, to merchants around the country. But the other defining characteristic of this time was that there were a number of banking panics in the United States. And by the time of a particularly problematic banking panic in 1907, a New York banker by the name of J.P. Morgan said, "That's enough. I've had to bail out several of these banking panics, and he called on the government to again think about forming a central bank in this country. Now, you might think over that history that this issue might have come to rest with a little more acceptance of the idea of a central bank, but it did not. It was just as hotly debated in the early 1900s as it was under the time of Alexander Hamilton. And again, the public's distrust of concentrated power and the idea that we couldn't balance this private-public ownership became an issue. But this time, Congress, instead of looking to create a monolithic institution with this diversified ownership structure, decided that they would take a more intentional approach to trying to balance these two things to create a central bank. And they looked very carefully at what today we refer to as checks and balances to make sure that this institution could have a chance of surviving. The idea being, of course, that those that spend the money should not be able to influence those that print the money. And I'll return to that idea a little bit later. So the outcome was, in fact, the formation of a third attempt at central banking in the United States. This time, instead of naming it the Third Bank of the United States, they went another direction and referred to it as the Federal Reserve System. And that's because it contained two public and private parts. The public part was actually a government agency, which today we call the Board of Governors. And the private part were 12 regional banks that were dispersed around the country. And this checks and balances between these two proved to be far more durable in its design. In fact, it was given a 20-year charter, as the other two were, but at the time of renewal of that 20-year charter, Congress said, we're going to throw that out, and this institution has now survived more than 100 years in the United States. And so I want to talk a little bit about what is it about the structure of the Federal Reserve that has accrued to this durability, this idea that the public could trust an institution that had this kind of influence over money in their economy. Let me describe for you briefly what these two parts of the Federal Reserve System do. So the Board of Governors is the government agency. It is the part that is designed to represent the public, and its members, and there are 7 of them, are chosen by the President of the United States, and they are confirmed by the Senate. And they serve 14-year terms. These terms were designed to outlast any single administration so that political insulation would be provided for the decisions that they'd have to make. The other part of this central bank, which is the private part, were 12 regional banks. They are owned by the purchase of stock by the banking system, essentially. And their leaders, the presidents and CEOs of those 12 regional banks, are not appointed by the President of the United States, but by a board of directors. And those directors consist of bankers, they represent merchants, they represent community leaders. There are 9 directors whose job it is to select the Fed president, and then the folks in Washington can give the thumbs up or the thumbs down on that particular selection. The job of these 12 banks is very different than what the folks do in Washington. At the Kansas City Fed, for example, there are 1,800 employees that come to work there every day, and they are carrying out essentially 3 different operations for the Fed. There are economists there that are looking at monetary policy and regional economics. There are supervisors there that are looking at the safety and soundness of the financial system. And there are folks there that are providing payments, both on behalf of the United States Treasury and directly to the banking system in our region. So operations are going on every day, which inform the decisions that ultimately come to the FOMC. So let me take you now inside the FOMC deliberations and how monetary policy is shaped by that structure. So every 8 weeks, I go to a meeting in Washington, joined by 12 Fed presidents, and 7 governors when they're fully staffed. There's only 5 there now. The president's 2 nominations have not been acted on by Congress, so it is a 17-member committee. My colleagues and I sit around a large oval table. How many of you have been to the Federal Reserve in Washington and seen the room for monetary policy? Some of you have. So it's a very large room. It's a somewhat intimidating room because you are reminded of the long history of people that have sat at that table and made decisions that affect the money supply in this country. But the rhythm to that meeting is a predictable one. It is a 2-day meeting, and the first speakers at this meeting are the 12 regional Fed presidents. And the first part of that go-round is to talk about what's happening in our regions. So in the case of the Kansas City Fed, I have a 7-state region. It extends from the western part of Missouri all the way to Wyoming and Colorado and New Mexico. And so you will hear me talking about the drivers of the economy in that region and how they've changed since our last meeting, what's happening in ag, what's happening in the energy economy there. And at the completion of that round of talking about regional economies, all 17 of us do another go-round talking about the national economy and what our outlook is for the national economy. And you might think with 17 people looking at the very same data, you would be hearing a redundant story. But you would be wrong, because you listen to each person go around that table and someone has a different view, someone focuses on a different aspect of the economy. And so we will spend a day really hashing through what's happening in the U.S. economy and how has that changed since our last meeting. The second day is a second go-round for the committee. And in that go-round, the question is, so what to do with interest rates relative to what we discussed the day before? Should interest rates stay the same? Should they be raised? And in some meetings, the question is, should they be lowered to stimulate the economy? And in those go-rounds, every person, again, can provide their views on policy. And at the very end, a subset of these 17 individuals actually cast a vote. So every one of the Washington governors vote at every meeting. The New York Fed president votes at every meeting. And that means the other 11 regional banks rotate their vote annually. So this year, I'm a voting member. Next year, I will rotate my vote to the Minneapolis Fed, and it goes on. So at every third year, I'll be a voter on that committee. And it's only at the very end of that meeting, when you cast a vote, that you see how the outcome of the meeting will be. And of course, last week, our meeting was a 7-3 vote. 7 members of the committee felt there should be no change in the interest rate, that the economy required additional progress to warrant raising interest rates, and 3 of the voting members, including myself, dissented against that option, feeling that it was time to raise interest rates in the United States, to begin to remove some of the historic stimulation that has been provided to the economy at that point. So the process takes in a diversity of views. It allows for debate and disagreement. And I'm often asked in the process of arriving at a decision, wouldn't it be better for everyone to reach a consensus? What is the point of having dissent on this committee? And I remind you that the public is looking to this institution not for its solid agreement, but to know that these issues have been thoroughly discussed and debated. And in a democracy like ours, the opportunity to dissent and to bring forward different views are by design to improve decision-making, are by design to earn the public's trust. And it is my hope that that's what that process does in this country. Let me close with some issues that ring familiar to what I suspect was going on in the country nearly 100 years ago, and frankly going back more than that if you think about the times of Alexander Hamilton. And that is the political focus on the Federal Reserve today and some of the issues that we face. So if you go back to 2008 and 9, the experience with the financial crisis required what most people feel was an aggressive response from the Federal Reserve. The Federal Reserve cut interest rates from 5.25% to 0%, and over the course of a few years, purchased bonds and grew its balance sheet from just under $1 trillion to today, $4.5 trillion. This is what central banks are designed to do during a financial panic, is to try to provide some kind of assurance to the markets. But the consequence of those actions are with us today, and they are with us today in a couple of ways. The Federal Reserve, as a bank supervisor, has been criticized for what was viewed as a bailout of the largest banks in this country, questions about why it didn't see some of these issues earlier, many questions about the nature of the monetary policy response that the Federal Reserve provided, such that today you find a very strong political reaction and calls for reforming the Central Bank of the United States. Those reforms today take the shape of everything from having Congress be more involved in monetary policy decisions by either setting a rule by which the committee would conduct its operations, would second-guess some of the judgments, all the way to the other side of dismantling the structure of the Federal Reserve, of doing away with the regional Fed presidents or making them political appointees. And I think during this time, I remind my own staff and others that I talk to that this institution is one that must be fully accountable to Congress. We are a creature of Congress. We are accountable to the public for our actions. But any changes to the Federal Reserve System will ultimately involve some sorts of trade-offs from where it is today. Will the institution become more public and less private in its scope? Will it begin to move away from Main Street connections and take on more Washington sort of policy focus? These are all the kinds of issues that I think will be consequential for our country in terms of thinking about the role that the central bank will play as we go forward. So I look forward to taking your questions, to hearing your thoughts about how the central bank works, about how monetary policy influences the economy in this country. And I want to thank you all again for inviting me to be here. Thank you. As the FOMC is making its decisions around the economy of the United States, how does it take into account what other countries are doing? It's a great question, because I would argue there was a time in this country where that might have been a minor consideration. In today's world, which is far more interconnected and global in its span, you will find the actions of other countries being consequential to the decisions that the Federal Reserve makes. In fact, you will see in some of our past decisions, even this year, some statements about monitoring financial and other global developments causing pause for the Fed's own decision. And why is that? Now, I'll remind you that the United States is the largest economy in the world. We are the world's reserve currency, which means most trade is done in dollars. And so it is, in fact, the actions of the U.S. Federal Reserve that can have very broad implications for other countries. I'll give you an example. In 2013, when the Federal Reserve undertook a third round of quantitative easing, those actions reverberated particularly around emerging market economies who saw that money flow in to them, and you saw them begin to have to deal with a number of challenges around that. So the actions are certainly connected in many ways. The question is, how much can you coordinate that? So as we watch the Bank of Japan, for example, drive interest rates into negative territory, as we see Europe driving rates into negative territory. In fact, today, $13 trillion, that's almost a quarter of the world's GDP, is operating with negative interest rates. Does that affect the U.S.? Absolutely. That means every time there is a hint of a rate increase in the U.S., you will see the strength of the dollar. So there have been calls for more coordination. In other words, can't we sort of talk about stopping the madness? These are my words in doing that. And the challenge is, remember, the U.S. Congress has given the Federal Reserve certain mandates. Other countries have gotten their mandates around their domestic economies. And so thinking about employment in the U.S., thinking about inflation in the U.S., are sort of benchmarks that Congress has assigned to the Federal Reserve. But there is no question that the actions of other countries, and I would argue that is complicating significantly some of the decisions that central banks have to make, is responding to each other. What's the likelihood that these reforms will actually materialize? And if in fact they do, so what? How will it actually translate to affecting you and I every day? So judging the likelihood of actions that Congress will take is a bit of a parlor game, right? It's hard to say with any certainty what would come of this. Let me tell you, one of my observations is there is significant interest on both sides of the aisle to do something. So that tells you this could be a live issue. The other thing we know is sometimes these actions get attached to things before you realize it. And I'll give you an example. Last year, late last year, Congress knew that the highway funding bill was about to expire and they needed money to be able to fix the nation's highways. They did something really extraordinary. They decided that the Federal Reserve would pay for that. Now, this happened pretty quickly, and the way it happened was Congress decided that the capital that sits in the 12 reserve banks would be swept out, and that the dividends that are paid to the banks that own stock in the Federal Reserve would be swept over to fund that. So this is a sort of an example I gave you earlier of where using the entity that prints the money to fund the people that spend the money. Here's what happens in countries that do that on a systematic basis. You will find that that sort of connection creates terrible outcomes for your economy, high inflation, and other kinds of distortions. Is that going to happen in this case? Probably not, but it is a bad precedent to set that Congress would do that. So what do I think will happen with some of these reforms? Let me pick one of these. What if the president of the Kansas City Fed has to be appointed by the President of the United States? Does that sound like such a bad thing? Maybe not, but here's what that would do. Becoming a political appointee would put me on the same level as the Board of Governors in Washington. It would suggest that the ability to differ from them, and I would just ask you to go back and look at history and look at how many times the governors dissent. It is a rare event to see a governor dissent. Fed presidents more often will. Why is that? They have their own staff of economists. They don't live and work in the same building. They're not appointed by the same process in doing that. And so you might not see immediate outcomes, but over the long run, I would argue it changes dramatically the structure and this sort of checks and balances. It will shift things in the direction of more public, and I would argue more political influence than what the institution has today. So it is a very smart question that you ask, because it's one that as I talk to people, you want to make sure that any changes to an institution that has this sort of checks and balances is well understood. What are the consequences? These should be studied carefully. They shouldn't happen overnight. They shouldn't happen because one particular interest group is pushing in that direction. But in the interest of the public generally, we should think carefully about any changes, I think, to the existing structure. So a very good question. One of the arguments that he notes is that given that the Fed is so close to zero today, The argument is, don't raise rates until you are absolutely sure, because if you have to cut them, you don't have room to go. And I find that to be a sort of a circular argument, right? Because what that suggests is you're never going to move. You are never going to have the kind of certainty in the U.S. economy. Shocks hit this economy all the time. In fact, in the last 6 years, we have seen this economy grow at a pretty steady 2% in the face of many of those shocks. So policymakers, in my view, must always look to the long run, must have sort of a strategy ahead to say we need to normalize the interest rate as the economy normalizes. And what do we see today? We see the unemployment rate has come from 10% to 4.9%. By almost any metric, you would consider that to be full employment in the United States. Inflation has remained low and stable. And again, under those conditions, we would normally be saying it's time to begin to move the interest rate up. So I don't find that argument compelling, which is you can't move because if you move, then you might have to do something else to lower it, and once you're at zero, you can't. That, in fact, suggests to me that the cost of being at zero or even higher than we thought when we went there 7 years ago, and it would argue to begin to take these steps to move away from that. So what do we make of Brexit? If you were at the FOMC meeting in June, which was also a meeting where there was great anticipation that the Fed might raise rates, only to find out that we didn't, one of the reasons was Brexit. And so it caused a lot of questions about, well, now, what is it about Brexit that would blow back on the world's largest economy? What does that mean for us? So I'll offer you a couple of perspectives on this. When you think about the cost of the UK referendum relative to Europe, I would argue it was costly to Europe. So the UK voters were expressing frustration about what seemed like inequities to them, what seemed about lack of control over economic policies, other policies. And so to have one of the countries pull away from Europe is consequential for all of them. And Europe is struggling significantly, not only with monetary policy and their economy, but struggling with what is the nature of the union fiscally. What does it mean to continue this Europe construct? So in that way, it was a costly decision, and it creates a lot of uncertainty, and it will create a lot of questions for the whole of Europe about what that means. The other question, and this was a question the FOMC faced, was what kind of uncertainty does this create relative to the U.S. economy, and could we get transmission effects through financial markets coming back to the United States? If you look at what our exposure is from a trade basis, you would say this is small. This is not going to be consequential to the U.S., and it's still my view today. I think these issues that the UK will be working through are going to be longer term. They will be slow moving in many respects. It doesn't mean that there can't be a spark there that will cause markets to be anxious. But I don't see over the next couple of years that this is going to be the kind of an event that will derail the U.S. economy. When you come into the meeting, do you kind of know people's priors and where they're coming at on these issues, and how can you be influential around changing others' views? So the answer is yes. You know going into a meeting what the options are. So ahead of the meeting, the committee members are told, here are the options, and we know which one is likely to be the option on the table. We also know from listening to each other at those meetings, but all of you, I would argue, know too, from listening to speeches that people give, where they are on these issues. You can listen to speeches and you will hear people like me say, I think it's time to raise rates. And you will hear others say, not yet. And so the public can sort of divine from there what people's positions are. Your question about is the job at the table to convince one another to each other's position. I will tell you in my own view that is really not the aim. This is not a sort of debate to see who can win the argument, because we know what options on the table. What you're asked to do as a member of the committee, and particularly when you vote, you are given a vote, and you are asked to come to that table to be prepared, to be thoughtful in how you consider these issues, but to be honest about how you see the issues as well. And if you don't come to the table prepared to express a different view, you do not serve the others on that committee very well, and I would argue you do not serve the public well by not presenting those views in an honest way. So for me, I always listen carefully, and I think others do too. You want to know, what is it about my position here that I'm not taking in and being convinced by keeping rates steady, taking more aggressive action? It's essential to listen carefully. But at the end of that, you are obligated to express an honest view at the table. And I think in the long run, that accrues to the credibility of the institution. I think it accrues to the public's trust in the institution that those kinds of views can come to the table.
He's interested in how the markets respond to the Federal Reserve, how varying that response is, and what you think the connection is between financial market response and Federal Reserve comments.
Yeah. So this has become, I think, a reflection of both the nature of the sources of media we have. It's become, I think, symptomatic of the decision-making point we are at in the economy around interest rates, that you find all eyes on the Federal Reserve. Now let me say, it is important for the Fed, generally speaking, that its decisions about monetary policy are systematic enough that you don't surprise markets, that you don't cause this kind of volatility. But I will also be honest with you. The actions that the Federal Reserve has undertaken over the last 7 or 8 years have been specifically aimed at increasing asset values. This was the purpose of quantitative easing, which was to boost asset values, to make people feel that that wealth would allow them to spend and that you would get this economy moving that way. And I would argue that's happened. We've seen housing values come back. You would see stock market prices at all-time highs here. And the question is, what happens then when the Federal Reserve begins to adjust that policy? So one of the consequences of this sort of unconventional policy that's been undertaken is, I would argue, you are going to have markets be more volatile than they have been. They are going to be more on a trigger of watching what the Fed does and reacting to that. Do I think that's good? No. Do I think it's inevitable given the kinds of policy that the Fed has undertaken? Probably so. And so it is, for me, one of the costs of the kind of policy the Fed has undertaken. And some people believe it has been well worth the cost. Some would argue the kinds of recovery that we've seen are worth it, and perhaps they're right. But it doesn't mean it will not be bumpy on the way to normalizing those decisions too. So it is a challenge every time a policymaker speaks, and it accrues to that every time there is an FOMC meeting. You get that kind of reaction too. The question is whether my argument to raise rates has to do with my optimism about the strength of the recovery versus those that would prefer to wait longer and let the economy proceed. So my argument has been for some time, and I believe this strongly. Zero interest rates are not normal interest rates. The price of money is like anything else. That price carries information, and it allows others to think about how to price risk in the economy. It affects how capital is allocated in an economy. And so when rates are so close to zero, you lose some of that effect. And what you risk is misallocating capital, mispricing risk, and at the point you adjust, you cause pain in the economy. And I'll give you an example. 2003, if you read the headlines in 2003 about the economy, they would look very similar to today. In fact, unemployment was a little bit higher than it is today. It was around 6%. But inflation was running a little bit low. And you saw the Federal Reserve holding interest rates at an unusually low level. And the argument was more time is needed to see the unemployment rate come down, to see inflation come up. And so instead of 6% unemployment, what we got in 2008 was 10% unemployment, because that was not a sustainable rate of interest for the long term. And my argument is the same today. If you keep trying to tighten labor markets to the point that you think you see inflation, to the point that you don't have a choice but to raise those rates more rapidly, you will cause more damage to the economy in the long run. And if you read the Federal Reserve Act, what it tells the Federal Reserve to do is look to the long run. And that is very hard for policymakers to do, because we're looking at data today. We're trying to guess whether that last number we saw is a change in the outlook or whether it's just a blip in the data. And so the discipline of looking to the long run is hard for all of us, but it is essential if you're going to achieve steady outcomes for the economy. So that's my argument. So the question is, how will a change in administration in this country affect tax policy? And I like your question because it's one that I think over the last 8 years, all eyes have been on the Federal Reserve, and all the questions have been about what can low interest rates do for the economy. And yet we know there are many other things that affect an economy. In fact, I would argue many things that could be beneficial to the U.S. economy that don't involve interest rates. And you've named one of them. A tax policy for any country has certain economic incentives. It has economic effects. And so I don't know, because whatever president comes into office is going to have to deal with a Congress on arriving at that. But it will take great leadership to look at the different economic policies, and taxes being one of them. If we are going to see the U.S. economy prosper in the future, if we're going to see it continue to grow, it will certainly take more than what the Federal Reserve can do with monetary policy. So I applaud you for reading the Fed's statement and the transcripts from the press conference. You may be one of a select few in the country that do that, including me. So the question is this: what is it you're going to do to assure that the economy can grow in the long run? 7 of my colleagues said leaving rates where they are is the answer to that. 3 of us argued it's time to begin to raise rates. All of us share the goal. All of us share the goal that we want the economy to grow, that we want unemployment to stay low and inflation to be low and stable over the long term. But where we differ is how close to the line can we get to assure those outcomes. And the truth is, none of us know that. These are judgments that are being made. So if you want to let the labor markets get tighter, the trade-off typically is that you will get higher inflation. And you will hear those that want to keep rates flat, let labor markets tighten, say it's not a problem if inflation starts getting higher because we know what to do. Then we can raise rates. And my argument and discomfort with that is to say what history tells me. Past committees have tried this same strategy. And what happens is they have to move rates quickly enough that then puts the economy in a recession. That's what I want to avoid, and that's the history I'm looking at. The other thing I'm looking at are the Fed economists provide us certain policy rules, we call them. They're sort of equations that say if growth is here and that, where would the interest rate be? Nearly all of those rules are telling us we're way behind already, that we should be raising it. So I'm putting more weight on history. People will argue, but today's economy is working differently. You can't rely on that. And the truth is, we won't know. And so from a risk management standpoint, I'm leaning in the direction of looking at what history tells me. Others are looking at something else. So how does the Fed think about student loans? We do talk about it. In fact, when we look at student loans, we're really trying to understand, can consumers continue to spend in a way that allows the economy to grow? Because consumers represent the great portion of our country's GDP. So one of the things you look at when you see how healthy is the consumer and how likely are they to spend, to say how much debt are they carrying today. And we know that student loan debt has now reached record levels. We now are seeing close to $1 trillion in student loan debt. That's higher than credit card debt. It's higher than many other kinds of consumer debt. So we look at it carefully to try to diagnose what is the risk to the consumer going forward. Our take on this, and again, people look at this from different angles, is that it sort of affects significantly certain pockets of people. So what do I mean by that? If you've incurred a lot of student loan debt, but you complete your degree and you go on to get a job, chances are you're going to be fine. You may not be able to spend in the same way you want, but you have a mechanism by which to pay off that debt. The groups of people that have incurred student loan debt that we worry more about are those who did not complete a degree and their debt isn't going away, or those that complete work in fields that are not in demand. So you may get a degree and have incurred student loan debt and not be able to find a job, or not find a job that pays in a way that can offset that. So clearly there are segments of the economy and consumers that will be weaker and not be able to spend as much. In terms of the macro effect on the economy, I think at this point it doesn't look like that would be something that would hit the economy all at once. So, if you look back, and particularly in my region, where oil and gas are important drivers of the economy, the drop in interest rates fueled what I called a commodity boom. They increased demand, they added a lot of capital investment in this area, and it depended on some very high oil prices. And what do you get when you overproduce something? We got a very textbook reaction, which is a huge drop in the price of oil, and that, of course, has reverberated. Now, that price has come back, as you noted, but most of the forecasts suggest that we are not going to see, at least in the near term, a balance in supply and demand in oil probably until next year sometime. So having that oil price stabilize is a good thing. We're beginning to see some modest investment come back there. Originally we thought when that oil price dropped, you heard many economists say this, you would have heard me say this will be a big boom to the consumer, right? This is going to be like a tax cut for them. It will be money in their pocket, and it was. But what I think we missed was how dramatic the capital investment had been in this space and the effect it had on the economy. We've seen business investment look fairly weak for several years, and I think largely attributed to oil and gas. The housing market has come back, but the housing market doesn't look anything like it did in 2007, and it probably shouldn't. But more concerning today is we are seeing a lack of supply of houses, and so prices are staying high, but it's hard to see new product coming online. Building new houses has been slower than we thought, but interestingly, the way that market is working is more people are remodeling, and that's about a third of how we account for residential investment. So I expect as people pour money back into their existing homes, that's going to provide some support to housing values. So that's an interesting question. His question is, when Congress made the decision to fund the highway bill with Federal Reserve funds, what role and what input did the reserve banks have? And I will tell you, not much. Interestingly, before Congress did this, they asked their analytical arm, it's called the General Accounting Office, to do a study to say, if we did this, what impact would it have on the Federal Reserve? They asked for that study last September. They made the decision in December, and the study is just now getting started. So the opportunity to weigh in has been provided. I had the opportunity to talk to the GAO about the implications of this, but it will require some further action by Congress to reverse what they did. And unless they find a pot of money somewhere else, that's going to be a hard decision. So it's a great question. His observation is over the last 5 years, the FOMC members have been wrong about their forecast for the economy and have had to ratchet down those forecasts. That's a question that everyone around the table debates about the why that is. I would tell you also private forecasters have also missed on this very thing. And it's because we assumed that what had happened after past recessions, which was the Fed lowered rates, stimulated the economy, you would see a bounce back in growth in the economy. We haven't seen that this time around. And there are various explanations for that. Again, you see business investment being weaker than expected. Why is that? Some will tell you it's because of the amount of regulation that has flowed to the economy over this same period. Some will tell you it has to do with still having some fear, given what happened in 2008 and 2009, that they are more conservative. And we have slower global growth as well. We have, across the world, sort of an aging demographic effect going on that many think is causing the economy to slow down. I'll offer you another reason that is not definitive, but it's one that we're studying carefully, and that is what effect as you get more concentration across industries. So as you get bigger and fewer companies, how does that affect growth in an economy? So I think there are many reasons for that maybe were not as apparent, but the 2008 and 2009 recession made them more dramatic this time, and so we've lowered our forecast. It's a great question because it has to do with how the credibility of central banks and how systematic committees are with setting policy expectations, and that, of course, has been a problem over the past year. So if you go back to 2011, you would have found the Federal Reserve talking about normalizing monetary policy. By 2012, it engaged in a third round of quantitative easing, which meant that in 2013, it had to revise what it thought about normalization. So this has sort of been a moving target. And for those that say we shouldn't be doing anything with rates, it's because they're looking for different outcomes in the economy than we've been able to achieve. So why not just suggest we'll do nothing, we'll just stay right here. So last December, the Fed made its first rate hike, 25 basis points. And of course, everyone wants to know, where are you going? And how many more of those are you going to do? And that is because we are working in a policy time, again, back to the other question, the economy is not working the way people thought it should work. They're reassessing their assumptions about the economy and how that works. But in my view, it is a handicap to our economy if we're not clearer about where we're going. So in a time of uncertainty, what is a committee to do? Do you do nothing and sit tight? Or do you, and this is my argument, do you rely on some traditional relationships, some policy rules that tell you this is where you should be going? You have 4.9% unemployment in the United States. You have low and stable inflation. Those are two important indicators that say you should not be at zero interest rates. So part of it is science, part of it is courage, and part of it is leadership to say, where are we going and how can we lay this out in the best case we can? We can be wrong, that's for sure, and I wouldn't want anyone to think that anyone around that table thinks they have the right prescription. But I don't agree that doing nothing gets you a better outcome.
We have other competition tonight and a debate in just a little bit, so I wanted to just end by thanking President George for a terrific talk today, for her